Imagine trusting someone so completely that you hand over your life savings without a second thought. For decades, thousands of people did exactly that with one man, Bernie Madoff. He was a legend in the financial world, a former chairman of the Nasdaq Stock Exchange, a veteran Wall Street trader, and a quiet confidant to the wealthy elite. Madoff had an aura of success and stability. He delivered steady returns year after year, weathering market storms with ease. On the surface, he seemed to possess a nearly magical financial acumen. But behind the polished veneer and the impeccable credentials lay the shocking truth. Bernie Madoff was orchestrating the largest Ponzi scheme in history, and he fooled everyone until the day it all came crashing down. Bernie Madoff's journey began humbly enough. Born in Queens, New York in 1938, he was the son of a plumber-turned-stockbroker. In 1960, armed with ambition and a few $1,000s saved from odd jobs, the young Madoff founded his own firm, Bernard L. Madoff Investment Securities. He started as a scrappy market maker in penny stocks, working long hours to match buyers and sellers. Over the years, his firm grew in prominence. Madoff was an early pioneer of electronic trading and helped revolutionize how the stock market functioned. By the 1980s, he had built a sterling reputation on Wall Street. He was respected, revered, even as a self-made financial guru who always seemed one step ahead. In the 1990s, he served several terms as the chairman of Nasdaq, cementing his status as a trustworthy authority in finance. Clients and colleagues alike saw Bernie as a man of integrity and skill. Little did they know that this very reputation would become the key ingredient in his audacious fraud. At some point in the 1980s, Bernie Madoff veered onto a dark path. He quietly opened an investment advisory business alongside his legitimate brokerage. This side business promised select investors an exclusive chance to benefit from his secret trading strategy. Madoff claimed he had a proprietary method, combination of buying blue-chip stocks, hedging with options, and timing the market that could produce remarkably consistent profits. It sounded too good to be true, but Madoff's clout made it believable. Clients flocked to him, eager to have their money managed by the great Bernie Madoff. What he was really offering, however, was a fantasy. Instead of investing their money, Madoff was running a classic Ponzi scheme, using the cash from new investors to pay profits to earlier investors. No actual investing or trading was happening behind the scenes. He was simply shuffling money from one client to another, all the while skimming millions for himself. The deception was meticulously planned and chillingly simple. Every month or every quarter, investors received account statements from Madoff's firm, showing steady growth in their portfolios. The statements looked legitimate, detailing stock trades and options positions supposedly executed on their behalf. If the market was up, the statement showed Bernie had made shrewd trades to capitalize on it. If the market was down, somehow he had protected their money and still eked out a gain. In reality, these trades never happened at all. Madoff and a handful of trusted employees fabricated the numbers. They even backdated trades, poring over old stock charts and price histories to pick the most profitable trades after the fact, and pretended that's what they had bought and sold for the clients. It was financial theater, and everyone was playing their part except the investors, who had no idea the script was fiction. On paper, everyone was a winner. The profits were pure invention, but the statements reassured investors that their money was not only safe, it was growing inexorably. The illusion of profitability was so convincing that people would show these statements to their accountants and brag about how well their investments with Madoff were doing. Madoff carefully cultivated an image of exclusivity and trust to keep the scheme going. His investment fund wasn't advertised to the general public. It was by invitation only. To get in, you often had to know someone who knew Madoff, perhaps a country club friend or a business associate. Many of his clients were wealthy individuals in the elite circles of New York and Palm Beach, or institutions and charities that heard of his uncanny track record through word of mouth. Being invested with Bernie Madoff became a status symbol, a mark of prestige that indicated you were part of an exclusive club. Paradoxically, this exclusivity made investors trust him even more. They felt lucky that Madoff had accepted their money, rather than suspicious of how secretive his operation was. If you asked how he achieved his results, he would give a cryptic shrug and speak of his special strategy or his decades of experience. Few pressed for details. After all, he was Bernie Madoff, the Wizard of Wall Street. Who were they to question his methods? This trust and reverence were Madoff's armor. It blinded his clients to red flags and allowed him to deceive even the most financially savvy individuals. To further maintain the facade, Madoff made sure that investors who wanted to withdraw funds could do so smoothly, at least in the scheme's early years. If someone needed their money back, he would simply use funds from new investments or whatever cash was on hand to fulfill the request. Investors would get their requested withdrawals promptly, with no fuss, reinforcing the notion that their money was both safe and liquid. This was crucial. If too many people asked for their money at once, the whole scheme would collapse like a house of cards. So long as most of Madoff's clients left their funds in his care, tempted by the steady returns, he could use the relatively small outflow to keep everyone happy. And for a long time, that balance held. Year after year, more money flowed in than was taken out. Madoff's growing reputation attracted a steady stream of new investors, and these fresh funds kept the engine running. In essence, he was robbing Peter to pay Paul, and as long as Peter was a never-ending line of wealthy newcomers, the fraud remained hidden in plain sight. Amazingly, Bernie Madoff managed to keep this charade going for over 2 decades without being exposed. There were moments when cracks nearly appeared. A few astute financial experts looked at Madoff's remarkably consistent returns and thought, this just isn't possible. One such skeptic, a financial analyst named Harry Markopoulos, tried to reverse engineer Madoff's strategy in the late 1990s and quickly realized that the numbers didn't add up. He suspected it was a fraud and went to the Securities and Exchange Commission, SEC, with his concerns. In fact, Markopoulos repeatedly warned the SEC for years, famously writing a report in 2005 titled, "The World's Largest Hedge Fund is a Fraud," that laid out the evidence against Madoff. Incredibly, these warnings were ignored or mishandled by regulators. Madoff's reputation, combined with the complexity and secrecy of his operation, gave him a Teflon coating. The SEC did conduct brief investigations into Madoff's business at various points, but they never dug deep enough. Bernie smoothly reassured examiners, offering partial information and plausible explanations. He was a savvy insider who knew exactly what to say to allay suspicion. Investigators failed to verify his trading records with third parties or fully understand how his investment advisory was structured. Each time questions arose, Madoff emerged unscathed, which only emboldened him and further convinced his investors that nothing was amiss. By the mid-2000s, Bernard Madoff was managing astonishing sums of money. On paper, his clients' accounts collectively showed tens of billions of dollars. In reality, much of that was the phantom profit he had fabricated. The actual pool of money, what hadn't been paid out to others, was far smaller. Yet in those days before the fall, Madoff appeared untouchable. He moved effortlessly among the upper crust, a philanthropist and a fixture in high society. He donated to charities, attended galas, and was regarded as a financial elder statesman. Clients would thank him profusely for the stability he provided to their fortunes. Some even toasted him at weddings and celebrations for securing their family's future. Behind closed doors, though, Bernie must have lived in constant fear of the inevitable day when the house of cards would collapse. Every Ponzi scheme, big or small, will fail unless it finds an infinite supply of new money. He knew he couldn't keep it going forever. By his own later admission, he had contemplated confessing earlier, but just couldn't bring himself to do it. Perhaps he hoped against hope that somehow he could fix it, or perhaps he was simply addicted to the power and the image of success. Whatever the case, by 2008, his scheme had grown to staggering proportions, and the clock was running out. The reckoning came with the global financial crisis of 2008, a cataclysm that shook the entire world economy. As markets plunged and credit dried up, even Madoff's wealthy investors found themselves in need of cash. Many had suffered heavy losses in stocks and real estate, and now turned to the one investment they thought was rock solid: their Madoff accounts. In the autumn of 2008, requests for withdrawals from Madoff's fund began to snowball. At first, he managed to meet the demands using whatever funds were available. But as the weeks went on, the requests kept coming, growing into a flood. Clients wanted billions of dollars out, all at once. Under normal circumstances, an investment manager might sell securities to raise cash, but Madoff wasn't holding the necessary assets to sell. Normally, he would find new investors to cover these withdrawals, but in late 2008, new money was almost non-existent. Fear had gripped the financial world. People were no longer looking to invest. They were scrambling to preserve what they had. For Bernie Madoff, this was the worst-case scenario. By early December 2008, he was facing roughly $7 billion in redemption requests that he simply could not fulfill. The accounts were virtually empty. After decades of deceit, the moment he had dreaded was finally here. The Ponzi scheme was unsustainable, and the walls were closing in. In those final days, Bernie Madoff seemed to accept that his empire of lies was collapsing. On the 10th of December, 2008, he invited his sons, Mark and Andrew, to his Manhattan apartment for an urgent meeting. Both men worked in the legitimate trading arm of their father's firm and had always been kept in the dark about the illicit investment advisory business. That evening, with a heavy heart, Madoff confessed to his sons what he had done. He told them that the wealth management business was a giant Ponzi scheme, one big lie from start to finish. He admitted that there were no investments at all, that for years he had been paying returns to clients, not from profits, but from the money new clients invested. As he spilled the truth, Bernie said he was broke and that it was all about to implode. One can only imagine the horror and betrayal Mark and Andrew felt as their father, the man they had looked up to, revealed himself as a fraud. The shock was indescribable. Their family's illustrious legacy was built on a criminal lie. That night, the brothers went home reeling, but they knew what they had to do. They consulted a lawyer and, within hours, alerted federal authorities to their father's confession. They understood that if they stayed silent, they would be complicit in the crime. The very next morning, the 11th of December, 2008, FBI agents showed up at Bernie Madoff's door. When the FBI arrived at Madoff's penthouse early that day, they found him oddly calm, as if he had already surrendered to his fate. An agent asked if there was an innocent explanation for what was happening. Madoff reportedly shook his head and replied, "There is no innocent explanation. He knew it was over." The agents placed him under arrest, and the man who had once been the toast of Wall Street was led out of his home in handcuffs. News of Madoff's arrest and the colossal fraud he had confessed to spread like wildfire. Wall Street, already reeling from the financial crisis, was in collective shock. How could Bernie Madoff, the Bernie Madoff, have deceived everyone for so long? How did no one see it? As the story broke, stunned investors around the world realized that the fortunes they thought they had were likely gone. Many had paper wealth with Madoff that turned out to be an illusion. The trust they had placed in him evaporated in an instant, replaced by anger, fear, and overwhelming grief. It was one of the most dramatic falls from grace in financial history, and the repercussions were just beginning. In the weeks after the scandal erupted, the full scope of Madoff's deception came to light. Investigators pored over the books and found that according to the last account statements, Madoff's clients believed they had about $65 billion in their accounts. In reality, only a fraction of that money actually existed. Roughly $17 billion of original investor cash had flowed into the scheme over the years, and much of that had been paid out to keep the ruse alive or spent. It was as if tens of billions of dollars had evaporated overnight. Thousands of victims suddenly faced the devastating truth that their nest eggs, pensions, and charitable funds were gone or severely diminished. These victims weren't just faceless millionaires. They included ordinary individuals and families, retirees who had entrusted Madoff with their life savings, and charities that depended on those funds for their good work. Lifetimes of effort and trust were wiped out. Some people lost everything. Longtime friends of Madoff felt personally betrayed and humiliated for having vouched for him. Charitable organizations had to close programs or shut down entirely because the endowments they'd invested with Madoff had vanished. The pain and anger in the community of investors was immeasurable. How could one man's lie wreak so much havoc? It was a question on everyone's mind as they grappled with the magnitude of what had happened. Bernie Madoff's reckoning in the justice system was swift. In March 2009, rather than drag out a public trial, Madoff pleaded guilty to 11 federal felonies, including securities fraud, wire fraud, mail fraud, money laundering, and perjury. Standing before Judge Denny Chin, he spoke in a flat, emotionless tone, as he admitted to running the massive Ponzi scheme and betraying the trust of thousands. He said he was deeply sorry and ashamed, but many of his victims doubted the sincerity of his remorse. At a hearing, some of them had the chance to address the court. One elderly investor told the judge how she had considered Madoff not just her financial advisor, but a dear friend who protected her family's money. Now she was left with nothing, her future in shambles. Another man described having to come out of retirement and work menial jobs after losing everything to Madoff's fraud. Their voices trembled with anger and pain as they looked at the man who had ruined them. Judge Chin, taking in the enormity of the crime and its damage, did not mince words. He called Madoff's actions extraordinarily evil. In June 2009, the judge imposed a sentence that made headlines around the world: 150 years in prison. It was the maximum sentence allowed, a clearly symbolic number that underscored the severity of Madoff's crimes. In essence, Bernie Madoff received a life sentence many times over. As the judge announced the punishment, a ripple of applause broke out among the victims in the courtroom, a rare and emotional moment in a court of law, signaling the depth of anguish and the small measure of catharsis this sentence provided. And so, the man who once strode the halls of Wall Street in fine suits was dispatched to a prison jumpsuit and a concrete cell. Madoff, 71 years old at sentencing, was sent to federal prison to spend the rest of his life as inmate number 61,727-054. He was stripped of virtually all his worldly possessions. Authorities seized his mansions, yachts, and bank accounts to eventually help reimburse victims. His wife, Ruth Madoff, found herself living a bizarre nightmare. Overnight, she went from enjoying a life of luxury to being the wife of a notorious criminal. Ruth claimed she had never known about the scheme, and while she was never charged with a crime, she faced public scorn and lost almost everything. She was allowed to keep only a small fraction of their fortune to support herself, roughly $2.5 million a pittance compared to the wealth they once flaunted. She left their penthouse and now lived under a cloud of infamy, estranged from many friends and mourning the life she thought was real. The Madoff family name, once associated with success and generosity, was now forever tainted. Madoff's two sons, Mark and Andrew, who had turned their father in, also paid a heavy price, though they themselves never faced criminal charges related to the scheme. The shock and shame of their father's betrayal never left them. In the aftermath, they struggled to rebuild their lives under the harsh glare of media and suspicion. Tragically, the weight of it all proved too much for the older son, Mark. Exactly 2 years to the day after his father's arrest, the 11th of December, 2010, Mark Madoff died by suicide. He was 46 years old and left behind a wife and young children. Many who knew him believed that he was haunted by the Madoff name and the devastating fallout of his father's crimes. Andrew Madoff, the younger son, battled cancer while trying to move forward. He succumbed to his illness in 2014, at the age of 48. Some close to the family felt that stress and heartbreak weakened his resolve to fight the disease. In the end, Bernie Madoff's deception destroyed not only the fortunes of his clients, but also his own family. It was an unbearable human cost added to the ledger of his fraud. In the aftermath of the scandal, a Herculean effort began to recover whatever funds could be salvaged for the victims. A court-appointed trustee took on the monumental task of untangling Madoff's accounts. This trustee and his team tracked down money and assets across the globe and pursued lawsuits against those who had profited from the scheme, investors who had gotten out early, or feeder fund managers who earned hefty fees funneling money to Madoff. Over the next decade, billions of dollars were clawed back through settlements and forfeited assets. Remarkably, a significant portion of the original investments was eventually recovered and returned to defrauded clients, something almost unheard of in Ponzi scheme cases. In some instances, victims who thought they had lost everything recovered a substantial percentage of their principal. However, for many, it was too little, too late. The financial restitution could not fully compensate for the stress, the lost years, and the opportunities that vanished. Still, every dollar returned was a small victory, hard-won from the wreckage Madoff left behind. Perhaps one of the most haunting questions in this whole saga is, How did Bernie Madoff get away with it for so long? In hindsight, the warning signs were there for anyone to see.